Welcome back to the Dividend Diplomats YouTube channel. You got Lanny the Legend over here. Thanks for that YouTube comment, suggesting the nickname. And you got Bert the Hurt. We're here to bring you another dividend investing video, and we are going to break down one of the major earnings releases that happened last week.
Smash that subscribe button. Give Bert and I a thumbs up. Bert the Hurt and Lanny over here. JP Morgan Chase, big banks. Earnings are coming out, and we can't wait to talk to you about it.
So get ready, everybody. You don't need to open up those financial statements. You don't need to open up those earnings release for JP Morgan, because we're about to break down what happened to you.
But you do need to get your Dividend Diplomat coffee mug.
I know, and I need to remember to bring mine next time when we film. So I'm using one of these substitutes, but it'll be back next week. With the coffee in hand, we are ready to go. We're about to break down JP Morgan. And why are we so focused on JP Morgan? Because they are the largest bank in the nation with over trillions of dollars in assets. And with how involved they are in the economy, how involved they are in everyday life, they give you some great insight to what's happening in the economy and where things may be headed in 2021.
If you remember back on our earlier videos, big banks are back. Most of the large banks, JP Morgan, Wells Fargo, Citi, Bank of America, Goldman Sachs, you name it, they passed the new, tougher, tighter Fed stress tests. And that allowed them to essentially resume share buybacks going forward and more than likely resume dividend increases. And with JP Morgan's recent earnings release, this puts a little bit of that icing on the cake, a little cherry on top for you dividend investors out there, because JP Morgan just blew the socks off their earnings. And Bert and I are going to go into why they did, and what they did is a good indication of what could be happening within the banking industry and the economy.
It's a fantastic summary point right there, Lanny. So we're about to run through some of the major items related to revenue, earnings, loan performance, discuss some of the action with the PPP loans, and some of the other general news. And then after we get through the news, we're going to take a look as, is JP Morgan an undervalued dividend stock to buy? So of course, you know how we do that. You've seen all of our previous videos. We're going to run them through the stock screener at the end to give you a full, complete analysis of JP Morgan.
All right, jabronis. JP Morgan came out, here yesterday, January 15th, and they set some record earnings here. First off, they soared with over $12 billion in revenue in that fourth quarter, Bert.
That's insane. That's one quarter, everybody. Make sure you caught what Lanny said. The fourth quarter, they earned over $12 billion in revenue.
It beat those expectations. I think one of the headlines is it's a good, bad year for JP Morgan. And I could definitely agree with that, because not only did they hit those earnings or that revenue right there from a performance standpoint, that then equated to $3.79 in earnings per share, crushing estimates by $1.17.
So think about what Lanny just said here. They beat on the top line and they beat on the bottom line. So that's how you know it was a strong quarter for the bank.
The banana was ripe on the top and the banana was ripe on the bottom. Yeah, that's a perfect peel.
Yeah, you don't have one of those yellow-green bananas that you sometimes get at the store.
Or that black bruise that you just did not even see from the peel. So how and why did JP Morgan crush these expectations? From the top line standpoint, I know loans grew by a little bit during the quarter. I want to say it was a little over maybe 1%.
Yep, that's exactly right.
And I think non-interest income was a heck of a lot better, that non-core revenue.
Yeah, and the other piece of it too, their assets under management continue to grow as well, earning fee income for the bank. So now their assets under management are up over $2.7 trillion.
Yeah, I think they've been attracting more of their current customers to just trade under their platform.
Yeah.
Making it easy. Not only do you have your checking, your credit card there, maybe your savings, direct deposits going in there, your economic stimulus, hitting those accounts, but you can also buy and sell your stock.
Yeah, so with more loans, more transactions, banks will earn interest income, they'll have a little interest expense, but they also have all that fee income from all of the credit card swipes that you have when you're purchasing things. Every transaction earns them revenue. Larger customer base, more transactions, more revenue for JP Morgan as well.
Now, from an earnings standpoint, JP Morgan at $3.79 EPS in this quarter alone. Now, a big impact to that quarter was because they reversed almost $3 billion of their allowance, aka reserves, aka the stockpile, aka the cushion.
Yeah, so for those of you that may not be as familiar with banks, when you originate a loan, you always have to book some sort of expense on the front end to reserve as the cushion, as Lanny just said, for loans that may go bad over the future. It's a nice little accounting standard that we happen to know a lot about, since this is one of the industries we work through for a lot of our careers. But you estimate the total cushion and you record the expense accordingly based on the total number of loans. It can be based on performance, expected losses. So if you expect more losses in your portfolio, a larger cushion. If you expect less losses going forward, lower cushion. So JP Morgan lowering that cushion could be from a majority of factors, but they could be expecting less losses on that portfolio as the economy starts to turn the corner into 2021.
Yeah, so that $3 billion reversal is actually almost 10% of their allowance in the quarter 3 at the end of September. So we're talking a large reverse. And that actually led to a 72-cent earnings per share impact. So when you actually take that back, you're looking at earnings at just over $3 per share instead of the $3.79. Still crushing those expectations. Now, I know there's been a lot of discussion of, like Bert was already indicating, why they reversed it. Is the economy getting better? Do they see more certainty versus uncertainty? Is housing better? Is, commercial real estate better? Or what does this mean for taxes? Do they say, let's take it in now in 2020 when we can versus 2021 because of future tax hikes? I don't know yet.
Yeah, we'll find out more as we come through, but with the stimulus checks coming, with less possible losses and defaults on loans, that's only a good thing for banks and their balance sheets, as less losses are expected from there.
So obviously they had a significant increase in their deposit base. Especially going forward in Q1 2021, deposits will increase. The economic stimulus, all those $600 ACHs and check deposits from, again, that economic impact payment 2, or that quick relief that everybody just received. JP Morgan was a big receiver of those funds. So more deposits, the bigger the ability is to lend and to do something with those assets on deposits. Their capital ratio stays sound and healthy as well.
Yeah, their deposits grew up to 30%, and based on what they said in their earnings release, which is just insane. With that 30% increase in their deposits are now over $2 trillion.
Not millions, not billions, but $2 trillion. So that deposit base is huge, and that allows them to be fluid, flexible, and keep capital levels high.
So if you want to know why the yield on your high yield savings accounts are decreasing, this is why. Banks are flushed with cash. Their deposits are increasing like crazy. They cannot pay a high interest rate on there, or else you would not be seeing record earnings recorded by banks.
Well, especially because what they can earn is a lot lower due to the federal funds rate being at 0 to 0.25% range. Essentially, all the margins are getting squeezed right now across the banking industry, and it'll probably continue to decline unless somehow the long-term curve comes back up. But we are not going to get into that.
That's another video, but a very excellent summary, Lanny, of why that's happening. Great, thank you.
But the stimulus, again, Joe Biden coming in, and Joe, he's going to more than likely sign this $1.9 trillion package, which could deliver, I don't know, was it 2,000 or 1,400 to make up?
I think it was 1,400 was going to be delivered, so that's more cash coming into these accounts.
And again, the big 3 favorite letters amongst the small business community, PPP is back, which means JP Morgan is going to be back lending to the small businesses. Not only do they potentially earn a small interest rate of 1% on the loans here, but they'll earn a nice fee for each loan that they complete and close and fund. So JP Morgan is going to be, pummeling the economy here with new PPP loans.
Yeah, so let's summarize here. What's going on in this earnings release? Insane revenue, strong growth in earnings, crushing analyst expectations. They reversed a huge amount of their allowance for loan losses, but still maintaining a very nice cushion in there. They've seen deposits cross $2 trillion, and with more deposits coming down the line when even more stimulus gets pumped into the economy. And also, they're going to benefit from PPP. I didn't want to leave that last one out.
Right, so now the question is what do you do as a current investor, and are you looking at JP Morgan as a future investor? Well, that's where the Dividend Diplomats come into play with the Dividend Diplomat stock screener, Bert.
Yep, and just to summarize quickly, what are the metrics of our stock screener? Price to earnings ratio less than the S&P 500, which is currently around 35 to 40, which is the range where it's fallen. A dividend payout ratio less than 60%, although we love our perfect dividend payout ratios between 40 and 60%. Then we look at the dividend growth history where we evaluate their average dividend growth rate and how long a company has been increasing their dividend. And don't forget, for all of our videos, we have that fourth bonus metric, the dividend yield.
And obviously we don't look at the dividend yield first. We like to look at it last just to say, okay, is this good from an income standpoint? So JP Morgan currently trading at just under $140 a share, a little over 138 right now. So they've been in that range. And in fact, they've, I think, ballooned over 40% in the most recent few months, which is insane. But looking at, the expectations from a share price and price to earnings ratio standpoint, the price to earnings ratio is under 15.
Which is still insane. Because again, with that market trading where it is that I mentioned earlier, 14 is way below the market.
Now, when Bert here dives into the dividend payout ratio, this is going to show real signs for that dividend growth, because as a dividend investor, you want that income to grow. So Bert, what does that dividend payout ratio look like?
Yeah, we're calculating a 27% dividend payout ratio. However, let's not forget the last video that Lanny talked about earlier there, where banks got the go-ahead from after the stress test to begin returning capital to shareholders. JP Morgan announced massive buybacks. I'm sure with record earnings continuing and what we'll see starting in 2021, there will be a return to dividend growth. 27% dividend payout ratio, there's a lot of room to grow that dividend going forward.
A ton of room. Buybacks more than likely are going to happen this quarter. They didn't do any in Q4, but I'm expecting Q1, some of that cash being returned back from the buyback standpoint. Going into that third Dividend Diplomat stock metric, the dividend growth rate. This is where it's huge. Not only has JP Morgan increased dividends for 10 years technically and going strong, but that 5-year growth rate's over 16%.
It's insanity. So I would honestly expect something similar once they get the go-ahead to start increasing their dividend once again.
For the love of God. Stone cold.
So now when we get to that fourth and final that bonus metric here, the dividend yield, obviously with their share price jumping, the dividend yield has come down. The dividend yield is still at a nice premium compared to the broader market. Their current dividend yield is 2.6%. which with the S&P 500 yield is usually between 1.6 and 1.8%. That's a nice little premium there for JP Morgan shareholders.
It's a nice premium. You're getting, 6 to 7 times what you're getting in your high yield online savings account. Again, to summarize the metrics for JP Morgan, again, ticker symbol is JPM, price to earnings at just over 14, below 15, dividend payout ratio at a solid and low 27%, plenty of room for growth. The dividend growth rate is over 16% and going 10 years plus strong with a 2.6% dividend yield. And another little asterisk on JP Morgan, they are led by one of the biggest banking gurus of this past decade and beyond that, Jamie Dimon, who's just been a blessing to the financial institution industry.
And I couldn't agree, Lanny. Jamie Dimon has done a lot for the banking community. He gives a lot of great insight. If you ever get a chance and you want to learn more about the economy, banking, and whole, just listen to some of his interviews on YouTube. They're great. So when you're being led by somebody strong that will help you lead you through this, you can see why they're having record earnings.
Bert may just have them, on his ceiling when he goes to bed.
I do not.
So JP Morgan, strong fourth quarter, good indication of where the economy is right now. Pulling back reserves, looking promising going forward. Still a little bit of uncertainty because we're still in the pandemic. Solid dividend stock metrics. I know I'm not going to currently buy right now, as I think there may be better dividend stocks that are in the banking industry out there.
Yep, I agree with Lanny. It's not that JP Morgan's a bad bank stock at all. Just their stock price continues to soar. So we're going to continue rolling up our sleeves and digging through bank financials as they come out over the next 2 weeks to find some of the best undervalued banking. I think that maybe that might be a great video that we'll do a few weeks down the road once we can dissect some of these earnings.
And if you're a current shareholder, congrats. You've had a very good run as a shareholder right now. I know if I currently own them, I'd probably still hold on because I love dividend growth stocks and rarely, if ever, sell a dividend stock unless the fundamentals actually change.
And we can tell you these fundamentals are strong right now for JP Morgan, as you can see, so I can see why you wouldn't want to sell them.
You know, again, if you have any questions, please leave them in the comments section below. We can't wait to see what you have to say about JP Morgan and what the big bank here is doing.
And if you haven't subscribed to our channel, please do now. We appreciate and love all the love and support we've gotten from the online dividend investing community, and that's really the key piece. We are a community. We push each other and we cheer each other as we hit new dividend income milestones.
Again, give us a thumbs up. This is Bert and Laney from the Dividend Diplomats.
Over and out.